Hey everyone, it's Mike the Mortgage Jedi, and today I'm going to tackle a question that's been on a lot of minds lately. Why did the Federal Reserve lower rates, but mortgage rates went up? If you're confused about this, you're not alone. So let me walk you through exactly what's going on in the market from my perspective as a mortgage lender. Now, first things first, let's clear up a big misconception. When the Fed cut rates, it doesn't directly lower mortgage rates. The Fed controls short-term interest rates, which are the rates banks charge each other for overnight loans. These Fed decisions influence things like credit card rates and short-term loans, but mortgage rates are based on long-term bonds and other economic factors. For instance, last year we saw mortgage rates dropping even when the Fed wasn't cutting rates. Why? Because mortgage rates are forward-looking. Lenders, investors, and the market in general are always trying to anticipate what's coming next, not just what's happening right now. So, even when the Fed isn't doing anything at the moment, the mortgage market is already factoring in what it expects the Fed to do in the near future, along with a host of other economic indicators. Let's take a closer look at what happened recently. The Fed made a rate cut that was larger than what most people expected. Everyone was forecasting a quarter point cut, but instead we got something a little bit bigger. Now, normally you'd think, great, a bigger cut should mean mortgage rates will drop even further, right? But that didn't happen. In fact, mortgage rates went up. So, what's going on here? The answer lies in market expectations. The mortgage market doesn't just react to what the Fed does today. It's constantly analyzing what might happen over the next few months. So when the Fed made that larger than expected cut, it caused a ripple of uncertainty. The market started asking, why did the Fed feel the need to cut more than we thought? Is there something going on in the economy that we're not seeing yet? Could we be heading toward a recession? This kind of uncertainty actually drives mortgage rates up because lenders need to hedge against potential risks in the economy. Then we had the jobs report come in. This was another key moment. The jobs report showed 100,000 more jobs that were created than economics had predicted. Now, this is good news for the economy. It suggests that the job market is still strong, which in theory keep the economy growing. But here's where it gets interesting. Because the job numbers were so strong, the market began to think, well, wait a minute. Maybe the Fed won't need to cut rates again after all. Maybe the economy is in better shape than we thought. As a result, mortgage rates went up instead of down. This happens because when the economy is strong, there's less need for lower rates to stimulate growth. And investors in mortgage-backed securities demand higher yields, pushing mortgage rates up. So where does that leave us now? Well, the reality is we're probably going to see more volatility in mortgage rates for the foreseeable future. We've got a few big factors coming into play. First, the upcoming election. Both candidates have different economic policies, and depending on who gets elected, those policies could be either inflationary or more conservative. The market is going to be watching very closely to see how that plays out, and the Fed will be reacting accordingly. Second, we need to keep an eye on inflation. Inflation is the big driver that the Fed is trying to control with its rate cuts, and also a major factor that influences mortgage rates. If inflation starts rising, that puts upward pressure on mortgage rates because lenders need to compensate for the declining purchase power of money over time. On the flip side, if inflation remains under control, we could see some stability in rates. But I don't expect a big drop in rates anytime soon, at least not before the election. Both candidates have policies that could influence inflation, So we'll need to wait and see how the Fed reacts after we know the election outcome. Now, I know some of you might be waiting for a dip in rates to make your move, whether it's refinancing or purchasing a home. My advice is this: don't try to time the market. If you're comfortable with the rates and payments where they are now, go for it. You can always refinance later if rates drop significantly. But waiting around for that perfect rate might mean you miss out on the home or deal that you want. And you don't want to do that. Let me give you a recent example. Back in September, we had a brief window where rates dipped lower than we had seen in a while. I reached out to a bunch of my clients during that window, encouraging them to lock in their refinance rates. Some of them did, and I'm glad they did because now rates are about 0.5% higher. Sometimes you just have to seize the opportunity when it's there because rates can shift very quickly and waiting can cost you more money in the long run. So what should you do if you're thinking about refinancing or buying? Reach out to your lender. Reach out to me. Every situation is different, and even though rates are a little higher right now, it could still make sense depending on where you're currently at with your mortgage or what your goals are. And one more thing to keep in mind. As we approach the end of the year, we're likely going to see continued rate fluctuations. The Fed has hinted at potentially more cuts, but they're also being cautious about how the economy is performing. Remember, the mortgage market is always trying to stay ahead. So even small changes in economic data, like jobs reports or inflation's numbers, can have an outsized impact on mortgage rates. So, to wrap things up, my personal outlook is that we'll see some rate volatility, but I don't expect a major drop before the election. And as always, the best advice I can give is to focus on what you're comfortable with right now. Don't make a decision based on where you hope rates will be in a few months. Make sure you're comfortable with the rate and payment today. Thanks again for tuning in. And as always, if you have any questions or need advice on your mortgage, please don't hesitate to reach out. I'm here to navigate you through these changing times and make the best decision for your situation. So stay tuned for some more updates, and I'll catch you in the next video. Bye.